Hello and welcome to this week's Market Outlook webinar with me, David Jones, and Aondo Markets. If you're watching the recorded version of this, it was held live on Wednesday, July the 12th at 12:30 in the afternoon. So this is a webinar that we do every week on a Wednesday lunchtime, and it breaks down into two parts. We'll have a look at some interesting markets and maybe some interesting trading setups for the days ahead. And also, we'll spend a bit of time talking about different aspects of trading and charting strategy. And this week, we are going to look at the Slow Stochastic, which I think is a popular indicator. It's one that's been around for a while, and people will use it to try and figure out turning points in the market. So we'll spend a bit of time looking at that. It's been an odd week. I think last week, I think I was saying this time last week, because we had the US shut for Independence Day, markets didn't really get started until Wednesday, and then of course on Friday last week we had the payrolls, so markets were waiting for those to happen. So last week was a bit of an odd one. The payrolls came out, the US unemployment numbers came out and beat expectations. I think just over 220,000 jobs added in the US economy in June against an expectation of 180,000. Later today, I think we've got the boss, the head of the Federal Reserve, Janet Yellen, testifying to some bit of the US Parliament, the US government. So as usual, whenever we see these people speak, the markets are always waiting and trying to second guess what it might mean for the future direction of interest rates and the health of the US economy, that sort of thing. So that's happening a bit later today, so we could see again markets waiting until that's out of the way. But that doesn't matter, we've still got some interesting things to look at. So what I'm going to do, I think that risk warning has been up for long enough now, so I'm going to just flip over onto the platform and we'll take a look. Let's just, there we go, let's maximize that. There we go, perfect. So this is Aondo's trading platform, Trade Hub. Let's bring up a chart. I've got a watch list set up here with a few things. So what we'll do, we'll look at a couple of markets first, and then we'll get into our sort of strategy section. So let's kick it off with euro dollar. It's been the same old for euro dollar over the last couple of weeks or so. It's continued to push higher. Let's just maximize this chart. Here we go. So nothing has changed. Now you can see even today, this is a daily chart we're looking at. Yet again, the euro has punched out to fresh highs for this bit of the uptrend that's been in place since December last year. So it's gone from 104 to currently above 114. So we've seen a 1,000-point rally, 10 cents in the euro this year, and it's still bullish. You know, it's a market where the trend is still up. There are some. Here we go. This is a weekly chart we're looking at now. There are some potential areas of problems, not a million miles away from where we are now. You know, we've got this old resistance coming in from August 2015, and then we've got a level back here from last year, from May. So there we go, coming in around about 116. So there are clearly, I think, for the longer term traders, there are some big levels to watch on euro dollar just above where we are now. But for now, you know, the trend is still strong, the market is still going up. The textbook approach would be to be a buyer of dips. If we're looking at levels to buy, let's flip over to the hourlies and see if you can pick up any support. I mean, that's a surge that we've seen over the last 24 hours. But you can see, I know I bang on about this every week, but just what a great job these old big levels do. So we had the low on July the 7th. That was payrolls, wasn't it? After the payrolls, so the post payrolls low at 113.80. Tested again on Monday of this week. Tested again yesterday, and the market's moved about 100 points off that level. So clearly, if we got a deeper sell-off from where we are now, back towards that, the 114 area, it looks like a buying opportunity. But that trend, you know, clearly still strong in euro dollar. Enough scope for more movement upwards, but just be aware of the big old resistance coming in around about the 116 mark first of all. Let's flip over to the pound. The pound, we've had this morning the latest unemployment figures, and I think unemployment is at its lowest in the UK since 1975. So that caused, I think, a small rally in the pound this morning, but it's been a pretty boring week for the pound. If we go back, these are now the daily candles that we're looking at. Clearly, we've got the old resistance left up here from May when it poked above 130 and traded up to about 130.50. It had another look at that during June, and so far that has proved to be strong resistance and good support down here at 126. You know, so for me, the trend for the pound is still up. So I'd rather be a buyer rather than a seller, but not necessarily sort of where we are now. You know, so I think we've got this trend off these old lows for January this year from 120 to where we're trading now. We've got this trend line still in place. So for me, that all still looks positive. So have a quick look at maybe some of the intraday levels to watch. Let's flip it over to an hourly chart. I mean, looking over, this is, you know, for the month so far, that trend is clearly down, you know, for the month so far. So for the short term, you know, directional bias would be to be a seller of rallies. You know, we've got the falling trend line coming in at about 129.20. We've got the highs from earlier this week in that sort of area again. So if we did get them, if we saw the market squeeze up, you know, 40, 50 points from here, it looks like a reasonable opportunity to go short, looking for a move back down, you know, to these lows from late yesterday. So at the moment, I think long-term trend's still up, but the intermediate trend for this month so far is definitely still down. But I do still think, you know, we'll see based on the daily chart that we'll see the pound back above the 130 mark. But clearly 130.50 is the big one to watch. If you can break that, it opens up these September highs around about 134. So for me, I think only if it starts losing 126 does the bullish argument sort of get thrown away. But I think for now, long term, you know, through 130.50 is what we're looking for, then back up to 134. Right, let's talk about stochastic. So we'll leave the charts to one side for a minute. I think there are it's a bit boring, pound and the euro at the moment, but I think there are some other interesting ones to look at. I think, and we're going to look at those once we've done stochastics. I think what's happening in bonds at the moment is really interesting, and also oil as well, which is a market that I hate traditionally, but I've started trading it a bit over the last couple of weeks. And I think, again, oil and bonds maybe are on the term based on what we've seen over the last few days or so. But first of all, let's talk about stochastics. So let me just flip my screen over and start scribbling stuff. All right, hold on a second. So here we go. So let's look at stochastics. So stochastics, it's quite similar to the RSI, I suppose. If we had a market that's doing something like that, and then stochastics get plotted below the market. So we have our, like in RSI, they're an overbought, oversold indicator, stochastic. So they're a stochastic line. Let me draw it first of all, and then I'll explain exactly what it is I'm doing. So there are two lines that go to make up stochastics, and it all sounds a bit complicated, but it's not really. So there are three things that go into making up a slow stochastic, and I think one way of thinking about it, it's like a smoothed out RSI. So the idea behind a stochastic, it's an overbought, oversold indicator, but with an element of smoothing involved, which tries to maybe take out some of the whippier signals. So there are three things that go in. There's this thing called percentage K, there's a thing called percentage D, and there's a thing called percentage DN. Percentage K, I always think of, it's the thing that does the hard work, but it doesn't actually traditionally get plotted on the chart. So percentage K looks at, let's say you've got a 5-day stochastic. It looks at, okay, where is the market trading now compared to where it has been over the last 5 days? So in that way, it's like an RSI. So traditionally, you know, a reading above 70%, if it's in the top 70% of the range, it's overbought. If it's in the bottom 30% of the range, it's oversold. So percentage K is the bit that does the hard work, but it doesn't get shown, because then percentage D gets plotted. So a typical value for percentage K is 5. Then the first line we see, traditionally, the first of these lines, is percentage D. And percentage D is really just a 3-day moving average of percentage K. Yeah, so it just smooths out some of those percentage K signals. And then the other line that gets plotted, the slower line, which traditionally on a 5-day stochastic gets given a value of 3, that's a 3-day moving average of the moving average. So it takes this line and it smooths it out again. So that's the maths behind the slow stochastic. So the actual sort of raw calculation is done here in percentage K, and then the lines that get plotted are just smoothed out versions of that. 10, 6, 6, 10-day, 6-day, and 6-day is another popular calculation of the slow stochastic. So, and the way it works is it's pretty similar to an RSI on a basic level. You know, traditionally anything above 70%, the market's said to be overbought. Anything below 30%, the market's said to be oversold. But you do have, like you have with moving averages, because you have two lines here, the crossover, when the percentage D crosses through the percentage DN, that's the signal to buy and sell. So we'll look at this in a real market in a minute, but it's these sort of setups. And what we also have, like we have, this is starting to look like something out of the film A Beautiful Mind, this, isn't it? But like we also have with RSIs, where we have divergence, we have that with stochastics as well. So like here, where the market hits a low, then moves a bit lower still, the stochastic should be following it lower. But in this example, the stochastic's making higher lows. So this is bullish divergence, when the market does one thing, but the stochastic does something else. We have these divergence setups as well. So that's the theory of slow stochastics and how they work. Let's take a look in the real world. So let's flip this over back onto here. Right. Let's stick with the pound for now. Let's stick with that. So let's plonk some stochastics on. Here we go. So there's our indicators. I must admit, if you've been on these webinars before, I'm not a massive fan of indicators, and this is the problem. Look how many there are. You know, I mean, this is not clearly a dig at the platform. You know, I mean, the software writers just respond to what people want. But look at all these different indicators. But let's go with the slow stochastic. Look at all the different flavors of stochastic you've got. We're going to go with that one, the traditional one, stochastic slow. There we go. So the values I've got, let me change the values. Okay, 5, 5, 3, 3. Okay, there we go. There we go. So this is pound against the dollar. Let's just zoom in a bit so we can get some bit of a clearer look at these signals. So the way it works is you can see how accurate my brilliant sketch was. You know, we have these two lines, and traditionally, if we're looking at it from just a crossover basis, let's go back through the last few signals. So let's go back to May. Here we go. So the percentage D crosses above the percentage DN. That was our buy signal. So that is there on the chart. I didn't do too badly. Then up here, it gets maybe a little bit messy up here because we have a sell signal. Then it sort of uncrosses, and then it crosses again to give us a sell there. But that was on there. And then we have a buy signal down here, which was all right for a few days. Then just about a sell signal there. Then a buy signal down there. Then the last, oh, actually no. Then the last sell signal we had was up here. Hopefully you can see that, where it crosses over. And then actually, is this happening now? This is happening. Well, it depends where the market closes today. But it looks like on the pound against the dollar, the slow stochastics are gearing up for a buy signal down here. So if you're a fan or if you're a new convert to slow stochastics, it's going to be an interesting one to see where it ends today. I suppose if you were going to follow that buy signal, the aggressive trade is to be a buyer of pound against the dollar at the close today with a stop under the low. The low is currently, it's a bit of a way away. The low is 128.12 today. The market's currently 128.70. So that's a 60-point stop loss. But if you believe the stochastics, it does suggest that maybe the market's gearing up for another move higher. And when it comes to this idea of divergence, let's see if I can spot any good ones. There's one down here. It's not a perfect textbook one, but where the market pushed to a low, the market pushed a bit lower again, but the stochastic was trending up. So there's an example of bullish divergence. Let's flip it over to the hourlies and see. Oh, wrong button. Let's flip it over to the hourly charts and have a look at our stochastics on there. There we go. So clearly we get more signals because we're getting a lot more data, a lot more frequent data, but the principles are the same. You know, the stochastic buy signal was at 9 o'clock this morning. the market's dragged its way up, and if the market sort of slows down and starts to turn here, we get a stochastic sell signal. We can sort of maybe slow these signals down a bit. If we go for 10.66, we'll have fewer signals, but the hope is they'll be a bit more accurate, I suppose. There we go. So there's our 10.66 stochastics. It's a bit mixed, to be honest. We've got actually bullish divergence. So yesterday afternoon, the market slips to a low, slips lower again, but our stochastics are making higher lows. So this was bullish divergence, suggesting that the weakness was running out of steam. That has been the case so far. And then you can see just the odd buy signals and sell signals going over in the past. So that's it. I think if you like things like RSIs, you know, the classic overbought, oversold indicator, then stochastics might give you a slightly different way of looking at the markets and a way at maybe smoothing out some of the more choppy RSI signals. But that's the idea behind stochastics. Right, let's take a look at some other markets. We'll do stock markets, then we'll take a look at oil, gold, and bonds, because I think they are all interesting at the moment. But let's look at stock markets first of all. To start off, let's do the S&P. It's the same old in stock markets. You know, I was saying a week ago how if we look, you look at the trend on stock markets. This is the S&P 500. So the trend off the the election, the U.S. election last year, the presidential election, that trend is still up, but the market has, broadly speaking, not gone anywhere for the last month. We've seen the odds nudge out to fresh all-time highs, but no real follow-through. But I think, as I was saying last week, you know, when we seem to get really sharp sell-offs. So if we change this to an hourly chart, we get really sharp sell-offs, like back here, end of June. When was that? Day before, was that? It was yesterday. Yesterday, sharp sell-off there. We get these sharp sellers, but they get bought back really quickly. You know, so clearly there's still an appetite to be a buyer of weakness. So there's not, you know, not too much more to say, I don't think, about US stock markets, although we'll look at the Nasdaq in a minute, because that is an interesting one. But, you know, on the S&P 500, whenever we see this market sort of snap back or sell off to the low 2400s, the buyers come back in and push it back up to 2430. You know, so there's a, you know, and you can just see, you know, how well that approach has worked over the last couple of weeks. I think it's only if we start to see the S&P trading below that 2400 mark that we have to worry about a deeper sell-off. But I think for now, the bias is still on the upside. Let's take a look at some of the European markets, because the DAX, the German 30, had been hit harder than others in recent weeks. But let's flip this over to a daily. But again, I think, you know, the bias, the longer-term bias, or even just back to November last year, the bias is still up. So we'd seen the DAX hit fresh all-time highs June the 20th, trading as high as above 12,950. It's been knocked back a fair old chunk. You know, it's been knocked back to 12,300. So what's that? A 5% drop in the DAX. But I think once again, the argument could be that we've built something of a base down here. If we flip this over to maybe the hourly charts, you know, we've seen it looks like that level has held. So here we go. There's the big level again. It's the big level ahead of sort of 12,300. So we hit 12,300 end of June, rallied nearly a couple of hundred points, came back to it last week, but you can see it held over a few days and the market's pushed higher. So I think for fans of patterns, this is arguably a double bottom that's been going on here, where the market's hit a level, trades higher, hit a level, hits the same level again, trades, and it's starting to break out. So I think it's interesting that this makes the DAX an interesting one to watch, because technically we should be a buyer of dips now. If we've got a dip, you know, back into this sort of range, it's a great opportunity with a stop below 12,300. But if we can see this break built on, then maybe we'll see a bit more strength in the weeks to come. So that's the DAX. But to wrap up the stock market a bit, let's take a look at the Nasdaq, because I was looking at this last week. We don't normally look at this, but I think, was it last week or the week before? Because maybe, you know, if we are going to see stock markets sell off, and you know, I think there's a lot of people, clearly month on month, as the market goes higher, who just think, well, the crash is getting near. Well, clearly it is, but whether that's going to be next week or in 10 years' time, who knows? But I think maybe because tech stocks, you know, have been a big driver of this rise. The so-called, is it the FANG stocks, which I can never remember what they are? Facebook, Amazon, Netflix, and Google. And maybe it's the Nasdaq that we want to watch to see if that does start to break down. But I think just a week ago, we were looking at this level from back here. Once again, it's the big levels. Let me plonk my horizontal line on. So this is a daily chart of the Nasdaq 100, the US Tech 100, as it's called on Aondo. So if we plonk our line on, there we go. So that whole, I think it's 5,500, 5,550 sort of area, was support, really sharp support on the way up in May. The market rallied 300 odd points off it, came back to it at the beginning of July, and you can see again, in the overnight market ahead of the open, has pushed higher again. So clearly I think that's a massive level, relatively speaking, from a short-term point of view, to watch on the Nasdaq, 5550-ish, 5500 to 5550. But it's interesting to see, I think that level that we were looking at a week ago has once again held the market up. Okay, now let's talk about, we're going to look at 3 other markets to wrap things up, and let's start off with oil. I've mentioned in the past, I'm not a fan of oil, basically because every time I trade it, I lose money. I can never remember when I last made money on the price of oil. But the trend, I think coming into this year, I thought we'd see more of a recovery from oil than we actually have seen. We saw last February it hit $26 a barrel, and then ended last year trading above 50. And I thought we're going to see much more of a follow-through. We haven't had it this year. It's traded broadly sideways, and then it's sold off. We've seen plenty of volatility. But I think it's been interesting over, actually just this week because of what's happened. So going back to June, we saw third week of June traded down to 42, and all the way up to 47. And then I actually started trading it again this week, and I'm amazed to report I've done 3 trades and I've had 2 winners on the price of oil. But I think the move that we've seen over the last 24 hours, maybe to me at least, suggests that we could see it gearing up for another move higher. So what I was looking at this week, it was really what day is it today? It's Wednesday today, so it must have been, it was Monday, I think. Yeah, it was Monday I did the first trade, and it was really the moves where it slipped to a low. It slipped to a low. This is post payrolls on Friday. So traded as low as 43.80, then rallied, and it came back to it on Monday, and it did push through. This is maybe clearer on a shorter term chart. If we flip it over to a 10-minute chart, it pushed through that old low, but it didn't have that much of a follow through. So 43, here we go, 43.80 was the low for Friday, and I'm a big fan of this actually, where classically, of course, a break of support or resistance suggests the market's going to carry on going in the way of the break. But often when you get a break where there's no follow through, it can clearly be a signal that it's a false break. And the appeal of false breaks to me is the fact you have great risk reward. So that was the low from Friday. So Monday it came down to it, poked through the low, rallied, poked through again for like 10 minutes, but held. So I ended up buying, I think about 43.80 is where I ended up buying, and a stop, I think 40 points, thinking, okay, if it starts to slip again and breaks through that low, then maybe I want to be out. The market rallied back up to the highs from Thursday of last week, and again yesterday. And what did it do yesterday morning? Oh, 12 o'clock, lunchtime, did the same thing again, came back to what was clearly turning out to be quite a big level. When it slipped below 44, we were seeing buyers come back in, so I bought it again, rode up to it, went short, and then bang, got stopped out. But there was 2, I think it's quite interesting, I think, how that sort of 43.80 to 44 level has held on oil over the last few days. And then we had this rocket move yesterday for whatever reason at 9 o'clock. Last night we've had this move higher. So I think, but bearing all this in mind, the downtrend it's been in looks like it's over. That downtrend that was in place for most of last week from sort of 47 level looks like it's over. The question now, I think, is how much of a pullback we get. I'd be quite tempted to be a buyer down here again, but I think if we do see it back to 44 in the next 24 hours, 48 hours, it looks like another buying opportunity, because this 43.60 to 80 level has done such a good job of holding up the price. So for me, in oil now, I think my expectation would be for a run up, at least back up above 47 again, and if we can break that, maybe we'll be having another look at those 50 levels from back in May. So I think that's an interesting one to watch. So hopefully, famous last words. I seem to have, in the short term at least, cured my curse on oil. So I'm paying a bit more attention to it now than I've done. The other interesting market, for similar sort of reasons, are bonds. I think I don't think, in my experience, having worked in the spread betting and the CFD industry, they're not popular with retail clients, sort of treasury bonds, German Euro bonds, and UK gilts. But they're a really interesting and technical market to trade. So I think the market. Let's take a look at bonds. Where am I looking for? Here we go. The September contracts. Let's bring that up. Because they're really technical markets. They're lots of liquidity, lots of volume goes through, and I think they are really technical markets. So let's have a look on a daily chart first of all. You get quite good trends when these markets start moving. The gaps are there because when it rolls over to a new contract, so it's not a continuous like a cash market. It trades quarterly. So this is the Bund contracts, so German Bund, and again it really had a great run, but it's fallen off a cliff in the last couple of weeks. And what is interesting for me is how it's performed in the last few days. So the trend has been down, but since Friday, and again actually probably from Thursday, it hit a low on Thursday around about 160.40. It slipped a little bit lower, maybe 8 points lower on Friday, but it hasn't really broken out, and it rallied and it's come back. Yesterday it came back within 15 points of that low, and the market's moved higher again, and it's starting to feel that maybe it's a market that wants to go up. So I think, oh yeah, someone's flagged up oil inventories this afternoon, so buyer beware. That's true. Every Wednesday, of course, we have the oil inventories from the US, how much they've got piled up in oil, so you can often see a lot of volatility for oil off the back of that, which could be an opportunity, but we'll see. But here's our Eurobond. So I just think some of the movements we've seen end of last week and beginning of this suggest that maybe we're seeing a base built in the bund. So for me, the level to watch are those lows from last Friday, just before the payrolls, at 160.30. But I think it's an interesting market to keep an eye on, and it's maybe, I think it's maybe not quite the level of volatility of some of the FX markets. It's quite a technical level in terms of in terms of support and resistance. And I just think it's an interesting market to watch. If you're looking at other stuff to trade, it's got typically a tight spread. Here we go, 3-point spread here with Aondo. I just think it's an interesting market to watch, and clearly a big market for professional traders. The last market we'll look at before wrapping things up, price of gold. This is another one like oil for me, where I thought the market's going to see more of a recovery this year. We've not done too bad on the price of gold. Let's flip it over to a daily chart. So from December last year, where it was trading around about 11.25 an ounce, we've been sort of within spitting distance of $1,300 an ounce, but it's sold off, in the last few weeks or so. But I think it's interesting. I mean, you could say, if you were a committed fan of trend lines, you could argue, well, the trend is over, it's broken out that trend, but and then it's broken out that trend, so it has lost some trend line support. But for me, the big levels are still very much intact. So for me, I think what we're seeing, or for me anyway, is a buying opportunity. We had the old lows from back here, which we had sort of poked through, but we've got these big levels back here around about 11.97, and over the last 2 or 3 days or so, we are seeing a bit of strength coming back in to the market. So I think it's an interesting one. I think for a medium-term trader to be a buyer down here and maybe with a stop the other side of 1,200, looking for the market to have another go at 1,300. So that's what 80 points upside and potential upside, and 20 points potential risk. I think that's an interesting trade. And also for the stochastics, as well, we've got a buy signal there that wasn't particularly good. We've got a buy signal just building up now. If it closes around about here, we'll have a buy signal building up here. But what we also have is bullish divergence, where we have the market has slipped to a low there, slipped lower still, but the stochastics are just about making higher lows. So that's all helped me talk my book on the price of gold. So I think it's going to be interesting, an interesting market to keep an eye on, I think, but maybe potential buy gearing up there. That's it for this week. I think we'll start wrapping things up there. If you have any questions, as ever, just drop me an email or get in touch on Twitter or something. But I think we've got Janet Yellen speaking this afternoon. There could be some volatility off the back of that. Every euro and the pound has been as it has been for the last few weeks. Stock markets have been pretty boring, but weakness keeps bringing the buyers back in. So maybe the commodities, the likes of oil and gold, are going to be the interesting ones to watch over the next few days. But I think there's plenty of potential opportunities out there, maybe slightly off the beaten track. But we'll wrap things up there. To follow me on Twitter if you don't follow me already, I occasionally post sort of half interesting charts on Twitter. It's at Jones the Markets. If you have any questions after today, just drop me an email, david@tradeafter.com. Aondo may be better known for social trading, and I've been blogging about a real live social account with real money, with a couple of £1,000 in, and that's on my website. If you go to www.tradeafter.com, you can read about that. I think it's up about 7%, I think, since February, just following other traders. So a relatively painless and hassle-free way of gaining some exposure. But we'll wrap things up there. The recording will be up a little bit later on, probably in about an hour's time, if you want to go over anything again. But thanks for coming along today, and I hope you're around to do it all again this time next week. But for this week, we'll wrap things up there, and I hope your trading goes well over the next 7 days.